Hi class, so this is another pre-recorded discussion on break-even point or the BEP analysis. This is part of module 5. So let's start off with our discussion. So what are the different project cost elements? No? When you're trying to have a business, you have many project cost elements. Number one is cost for manufacturing environments. Number two, the cost for financial statements. And number three, the cost for predicting cost behavior. So these are the cost for manufacturing environments. So basically it is divided into three broad categories. Number one, direct materials. These are materials or any materials that are used in the final product and can be easily traced into it. So for example, sa cellphone mo, kana imuhang metal, ang screen, that is what we call as our direct materials. Number two is the direct labor. It refers to those labor costs that goes directly into the product. So it goes into the fabrication of the product, no? So ang tao nga nagtrabaho gyud ana maugyoy what we call as direct labor. And lastly is manufacturing overhead. It includes all costs in manufacturing except direct materials and direct labor. Example are indirect materials and indirect labor, utilities kanang such as kurente and telephone, kanang mong telephone plus dili na siya directly associated sa imong produkto. But it is a requirement for you to continue the business ba. So those are what we call utilities. That is a part of your manufacturing overhead. So the cost for manufacturing, for non-manufacturing number. Wait a minute. So additional types of cost in support of manufacturing is operating cost, kanang warehousing and vehicles. So if you are making a cell phone, you have to have your own warehouse and vehicles for delivery units. And then marketing, selling, and administrative costs. These costs include all expenses necessary to secure customer orders and get finished products into the customer's operation. So kana siya na basically your full goods or your finished products requires shipping or supply chain to have it at the hands of your customer. Overhead or heat and light, property taxes, depreciation, and other similar items associated with selling and administrative expenses. So kana mag sa selling, magpalit kang sakyanan, you'll have to depreciate the value of the car and your hauling machine. 2, marketing, it is the advertising, shipping, sales travel, sales commissions, and sales salaries. And administrative functions, kana executive compensation, general accountants, public relations, and secretarial support. So cost for financial statements. So costs incurred to generate particular revenue should be recognized as expense in the same period that the revenue is recognized. So kung ato tanang cost nato nga atong gikuan ganiha, manufacturing cost, kanang sa tawag ito katong direct labor, indirect labor, and etc. It should be divided into 2. Number 1, periodic cost, and number 2 is the product cost. So when we say periodic cost, these are costs that are charged to expense in the period that they are incurred. Example, kung naa kay empleyado nga monthly nimo magsweldo, ang sweldo sa empleyado na monthly basis is part of your periodic cost. Okay? Because it comes into your cost on a monthly basis. So such costs are not related to production and flow of manufactured goods, but are deducted from revenue in your income statement. That are your salaries and wages and depreciation expense. Because that should be periodic. It will appear on the income statement as expenses in the time period in which they occur. So what is product cost? So product costs are matched against the product. So it involve the purchase or manufacturing of goods. And this is not viewed as expenses. They are cost of creating inventories, it is also considered an asset until the related goods are sold. So, kung mingon kag nakaproduce ka 1,000 ka cellphones, okay, ang nahalin nimo is 500 only. So, inighali na to imong 500, adto ra tumupatong ang cost sa produkto pagbuhat adto siya. So that is what you call as your product cost kanang sa metal. Kung pila ra gyud imong metal na gamit for the 500 units nga nahalin. So that is product cost, no? So not unless it is sold, it will be a work in process or it is still in your warehouse. Dili pa na siya mo-consider as a product cost. So it is referred to as also the cost of goods sold. That is the cost of the goods nga nahalin ra nimo actually. This includes all manufacturing costs. It appears in the financial statement as CGS or cost of goods sold until it is sold and not when the product is manufactured. Daily both pasabot ana niya nakaproduce ko 1,000. So within the month ako sa di-charge tanang cost niya ang 1,000 nga ako nagasto ana nga unit specific sa metal and etc. That should be not the case because if you do that one, fluctuating ang imuhang manufacturing cost. Kay kung pila ra imong gi-manufacture mao sa imong i-consider as product cost, which is that is the very reason there is a difference between periodic and product cost. So the three types of inventory costs are: number 1, raw materials inventory. This represents an unused portion of the raw materials on hand at the end of the fiscal year. 2, work in process. This consists of partially completed goods on hand in the factory at year end and finished goods inventory. Cost of finished goods on hand and awaiting sale to customers at year end. So there are different cost behaviors, no, that will define ang imuhang kana how you react or respond to changes in the level of business activity. That is what we call as volume index. It is a unit of measure used to define volume, maybe based on production inputs such as tons of coal processed, direct labor hours, or man hours, machine hours. Once volume index is identified, we can find out how costs vary in response to changes in the volume sa imong production. So there is what we call as unit contribution margin also. Unit contribution margin refers to the unit sales price minus the unit variable cost. And then contribution margin is total sales revenue minus total variable cost. So equation 1 states that the unit contribution that is based on a per unit basis, no? Be mindful kang ngayon kang per unit, number of unit ni siya. So every time mahalinan ko sa ka unit, pilay contribution niya sa ako ang profit. And then when it comes to on the total sales or on yearly basis, total na po imong basis. So basically it's the same but the difference is in terms of volume. So what are fixed costs? This is in other terms what we call as capacity cost. Why? It is a cost that has relatively wide range of output for which are expected to remain constant. This span is called the relevant range. And then, fixed costs do not change within a given period alone, although volume may change. Example, kanang building ni mo nga rent. When you rent a warehouse, the warehouse capacity, say for example, is 50,000 cases. And then, ang imong iso 10,000 ra. The cost that you are paying on the warehouse is at the 50,000 cases. That is what we call as fixed cost. So it disregards your volume and it has a fixed volume na jud. Okay? Depreciation of your buildings, machinery, and equipment. Then variable cost. It is a type of cost that has a close relationship with the level of volume. Examples are direct labor and direct materials. So example is sa cellphone is the metal. Magkadako imong i-produce na volume sa cellphones, magkadako sa ginukonsumo nga metal. So that is what we call as variable cost. And that as your volume increases, your variable cost increases as because it is a volume dependent na cost. And then break-even sales volume. So the point where total sales revenue is equal to your total expenses, or in other terms, this is at the point wherein you have no loss and no profit. It is very crucial because you need to identify what sale or volume should you sell for you to have no loss lang yun. Okay? So break-even point is defined as a fixed expenses over the unit contribution margin. Break-even point, in other terms, that is fixed expenses over the selling price minus the variable cost. So break-even analysis. It is a technique widely used by production management and management accountants. It is based on categorizing production cost between those of which are variables. So costs that can change when production output changes, and then the fixed are costs that is directly associated to the volume. So identifying the value of a particular project variable that causes the project to exactly break even. Kuan class, the very reason why we need to understand this one is una, when you try to create a business on your own, when you try to have an investment, you should be able to compute in which you have no loss and no profit, and then katong excess nimo nga kanang output na or excess nimo nga sale from your BEP, that is considered a bonus, no? Basically you are trying to have a plan in which your business should strive in the business. So the point in which there is no profit or loss is at this point, no? Because we very well know that your fixed cost as is gina siya, magbayad jud ka aning fixed cost direct. This is what you call as your fixed cost. Regardless if you have volume or not, imong fixed cost is gina siya. And then when you are trying to produce already, mosaka na imuha ng variable cost. Okay? And then your revenue starts at zero. If you have a sale of 1, increasing man na siya. So mao na imong revenue. So there is a point in your system, in your computation, wherein mag-meet na ang duha. You have the same revenue and the same total cost. Your total cost is the fixed cost plus the variable cost. And then your revenue is your profit per unit times the number of units. So the factors affecting break-even point, number 1 is fixed cost, number 2 variable cost, number 3 is the selling price or the profit margin. So say for example, Ashland Company manufactures and sells a single product. The company's sales and expenses for recent month are as follows. What is the monthly break-even point in units sold and sales in dollars? How many units would have to be sold each month to earn a minimum net income of $50,000? So, example, your sales is equal to $500,000. So that is, say for example, in terms of volume, that is 500,000 divided by 20. Your volume is volume 25,000. Variable expenses is 250,000 divided by 10. That is 25,000. So double check. Actually, I'm double checking the given. So your contribution margin is 250 or 10% per unit. Fixed cost is 150,000 and your income before tax is $100,000. So let's fixed cost is 150,000. Okay. So your break-even point basically is your fixed cost over the contribution margin, which is $20 man imong sales per unit or sales price minus the $10 na variable cost. Therefore, in order for you to meet a break-even point, you'll have to make 15,000 units. You'll have to make it and sell it to have no loss and no profit. And then, if your target income is 50,000, basically, the formula is that your revenue minus expenses is equal to your 50,000. Okay? So, revenue is provided as 20,000 times the volume. Say, for example, P minus 10 multiplied by the certain volume. This is your variable cost minus 150,000 as your fixed cost. Therefore, equals to 50,000. With that, you'll have to make 20,000 units to ensure that you have an income of $50,000. Next problem. Suppose that the company expects the following financial results from a project during its first year of operation. Sales revenue is 250,000, variable cost is 80,000, fixed cost is 50,000. The total units produced and sold is 1,000 units. Compute for the contribution margin percentage. Letter B, compute for the break-even point in units sold. And what is the income on the problem? So, if you'll try to divide this by 1,000 with the volume, dili ta mag-divide of 1,000 sa fixed cost plus 10. Fixed man na siya. So that is 250, 80,000, 80. Now, so we very well know that the selling price is 250 and the variable cost is $80 already. So we'll proceed to the computation. So provided that your contribution margin percentage is equal to 250,000, which is your sales minus the fixed variable cost, that is 170,000 divided by the total sales revenue of 250. Therefore, the contribution margin is margin percentage at the 68%. Okay, that is also in other terms, that is selling price is 250 minus 80 over 250. This is on a per unit basis. No, that is on a per unit basis. Letter B, compute for the break-even point. So basically the formula, fixed cost over selling minus minus the variable. Therefore, you have a fixed cost is 50,000 divided by 170 per unit. Therefore, your number of units in order to break even is at 295 units. Lastly, the income for the problem is 250,000, which is your revenue, minus the variable cost of 80,000, minus the fixed cost. Your revenue or income is equal to $120,000. Okay? So, that defines the whole Module 5 discussion, and this is the last discussion for Module 5. So, I hope you're able to understand the topic, and I'll meet you on a live Q&A for the specific topics. Thank you.